Hey everyone, welcome back to our February newsletter where we're taking a look at a recap of January 2024. We'll look at what's happening in the news, some monthly market insights, and then we'll look at what's hot in the market. Thank you for joining us. Wow, before I jump into the headlines, what I can tell you firsthand is that the real estate market is a completely different world than it was 6 weeks ago, 6 months ago. My company has done more resale transactions in the first 6 weeks of 2024 than we did in the last 6 months of 2023. So you guys are going to start reading about the headlines. We're in the trenches. The data comes from us 30 days after we report it as realtors and professionals and the real estate board. But what I can tell you now is when we jump into the headlines, into the data from January's growth, when I do this next month, it is going to be an even better story, more positive story. Things are really turning, and it's a really exciting time. We know we're exhausted. It's been slow in terms of sales. Me as an investor, I know how challenging it has been in terms of interest rates, mortgage payments, and also being able to tap into my equity to continue to scale my portfolio, which is really what I'm all about. So really excited to see some optimism back in the market. And this is a headline here from the Toronto Star. It's not just my team that's seeing life come back to the market. It's the Toronto real estate market roars back to life, ending short-lived buyer's market. I'm going to go into the data. I'm going to really break down what we're seeing and why it's a compelling time to be investing and buying real estate. This is a really interesting headline that came in from an article on BiggerPockets, a great news-related site for real estate investors. Warren Buffett is investing in new construction. Here's what you might want to hear, why you might want to as well. And this is a quote from the article, not from Buffett, but Buffett's decision is, in a sense, a shrewd prediction of where the real estate market is headed. This limited inventory is continuing to prop up housing markets even after they become largely unaffordable for buyers. Home prices keep going up despite massive interest rates for one simple reason. There aren't enough homes to go around. So this isn't a story just in Canada, the supply story. We're also seeing it south of the border and in different markets. I don't think it's nearly as pronounced or as serious of an issue as it is in Canada. But what is really telling and great about this article is that arguably the smartest investor to ever live is investing in housing, new construction, because they've identified supply and demand fundamentals are out of whack, and that will drive future pricing for housing up. So this is exciting. Edge Analytics, great provider of data for real estate, macro and microeconomic data and news. The inflation numbers down. What about rates? What a difference a week makes. All it took was one very soft inflation reading, and all of a sudden the odds of an April rate cut has gone from basically zero to only slightly under a coin toss. And now we have nearly four rate cuts priced in for 2024 when it was only two just last week. So take out higher mortgage interest rate costs, we're back at 2%. So what happened earlier this week? The inflation numbers came in and they came in below projected, so below 3% at 2.9%, which is within the target. The target is 2%, but within the 1 to 3% range is what really the Bank of Canada is trying to accomplish. Now, what's interesting, when you factor in housing, specifically the higher mortgage costs, you're actually back down to 2% inflation. So what we're talking about here is projections. This is what economists, major banks, industry economy professionals, they're forecasting that rates are now going to come down multiple times in 2024. All right, let's jump into the January market recap. I'm absolutely privileged to be a part of such an incredible brokerage. My team, Connect.ca, we recently moved over to Royal LePage Signature, which is a leading brokerage in the country. And what that means for us is we have access to incredible data. And we're really honored and thrilled to be here and be able to share with all of you all of this incredible insight and market data. This data that I'm going to be sharing, a lot of it is provided by Urbanation, which is one of the leading market data analytics companies in all of Canada. They're definitely leading analytics analysis in the GTA market and rental, resale, as well as new home market. And it's just really great to be able to share this data with you. So let's jump in. Really excited to see what's happening in the market. The GTA housing market started 2024 with renewed momentum driven by decreasing fixed-term mortgage rates and increasing optimism that the Bank of Canada will cut interest rates this year. This pushed some buyers off the sidelines looking to avoid paying higher prices in the spring. While there was more competition among buyers, they continued to act cautiously on prices given the still challenging market qualification environment. So a lot of the demand, obviously, over the past year and a half or so has been just piling up on the sidelines. It's not disappearing. It's there. People are ready to buy when the time is right, and it's waiting there. And in fact, that demand has been piling up. It's actually been building. So we're starting to see, as fixed rates came down late last year slightly due to bond yields, which are now back up again and then back down again, we saw some of that optimism come into the market. Now, I think once we start seeing real rate decreases, we're going to see the majority of that demand come off the sidelines, and you can call it what it is. But that might be too late for some buyers who may be priced out of the market if we see the same type of growth that we saw in 2023 when fixed rates came down. Total GTA MLS sales increased 37% annually to 4,223 transactions in January, which was 9% below the 10-year average. On a monthly basis, increased 23%, the strongest increase between December and January period since 2007. So we're below the 10-year average, which is no shock to anyone. What is sorry, my lights don't think I'm here anymore. What is a shock to the market is that we're seeing such a strong increase in, seasonally speaking, the worst time of year is typically December and January. So to see that increase month over month is also a telling sign that confidence and buyers are coming back into the market. New listings increased by a much slower pace than sales in January, rising 6% year over year. As a result, market conditions became more balanced to start the year, with a sales to new listings ratio of 51%, rising from 39% in January 2023 and nearing the 10-year average of 55%. That is telling. So what does that mean? That means sales are increasing, but supply is actually decreasing. So that'll eventually lead to a supply and demand imbalance, and we will at some point start to see prices go up. The question is, one, active listings were up 8% annually in January to 10,093 homes, which was 13% above the average, but 10-year average, I should say, but 17% below the 20-year average. Inventory levels fell for the third straight month, declining from 4.2 months in October to 2.4 months in January. We'll break that down shortly by housing types, but that's significant. We've got a chart, so I'm not going to spend too much time on it, but essentially what that means is if no new homes hit the market in October, it would have taken 4.2 months to sell all inventory. And in January, that has dropped almost in half, which would mean it would take 2.4 months for all of the inventory to be absorbed if no new inventory hit the market. That's why months of inventory is a key indicator, because that really highlights supply and demand. Despite the improvement in market conditions during January, average resale prices fell to a 3-year low of 1,026,000, decrease of 1% annually, and by 17.4% over the past 2 years. However, the recent decline was mainly attributed to a compositional change in sales towards less expensive homes as the ratio of sale price to list price increased to a 3-month high of 98%. So, when you look at 1 month of data, there are positive stories or compelling stories, and sometimes the data you might need to give it a bit more time. But what appears to be happening is, even though the average price declined, there were a lot less low-rise, higher price point homes sold. Where at the bottom of the market, we're starting to see most of the people come off the sidelines to buy in the condo market, first-time market, but sub 800, 900,000 market is really, really picked up versus the higher end market. And that's not only because there's not as much demand, but there's just actually way less supply. So let's look at the demand indicators. And I really like this chart. I'm going to have to squint my eyes because it's tough to see on my computer. But 2018 was a reset from 2017 mini bubble. So if we look at this is total sales, and I've pulled charts for the last 30 years, and this is a very cyclical, consistent thing that happens. Prices will start to take off. We saw that happening in 2016 into 2017. Especially in condos, we saw houses have a lot of growth, low rise in 2016. The price gap between condos and houses became very wide. And then we saw condos increase 22% in some markets that year. And that is when the market overshot. And then it came back down. If you look at 2008, you go back to 2000 and further, you'll see similar things. The market overshoots. But what is really interesting here, a very unique cause, I don't think it had anything to do with supply and demand or other than, COVID and lockdowns, is prices, interest rates tumbled, prices shot up, interest rates go up. Demand starts really wavering here in 2023 as the rates go up higher. And then we're starting to see optimism start driving demand here. So more sales. And then as rates come down, you'll start to see prices go up again, historically speaking. 2020, we saw record low in rates and money pumped into the market. That's a really big story I don't want to get all into, but, that essentially created a lot of that demand. Demand was created in this case, I think in all cases, by government policy or immigration policy, rate policy, tax policy. And then it often is policy that slows the market down as well. Mid 22, we saw the cause and effect of the higher rates kick in. So that is what I showed you here. Higher rates, that is the cause and effect. Last spring, rates dropped, fixed rates with bond rates, and prices shot up. And they overshot. And this is exactly what it is right here. So right in spring 2023, rate increases, and then bond rates started coming down. So fixed rates came down, and we saw a ton of people come off the sidelines thinking that was the end of the interest rate cycle. And prices shot up, sales shot up, prices went up in some markets 20%. And that's never a good thing. It's not a sustainable thing when you see double-digit growth, especially with the 2 in front of it. So what happened was anyone who bought at that peak, prices came down, as it almost always does when it overshoots. But then it comes back up again. So here you see it dropping, and you're starting to see now sales increase again with optimism. Supply indicators. So we looked at the demand side. Let's look at the supply side. 2017 high sales ratio before the Fair Housing Plan, mortgage stress test, and 15% non-residential sales tax. So the market really started taking off. Now, I talk about supply, the supply housing problem in the GTA and in Canada now, but mainly in Ontario and the GTA, as a bonfire. It's something that we can't put out. New even rates. It's like throwing water on a bonfire. Eventually, it's going to take back off again, and that's exactly what happened in 2017. In 2017, prices started taking off and the government got involved and they introduced the Fair Housing Plan, the mortgage stress test, 15% non-resident sales tax, and that sucked the life out of the market. And it picked back up shortly after. 2023 reset and 2024 is the turning point. So we're seeing the same thing that just happened. It really believes like we just got out of a trough. We're turning a corner. It may be a big corner, but there's no doubt that we're turning it. And 2024 will be that turning point. 2020 spike of months of inventory when government forced us into lockdown. You see that here in 2020, just shot through the roof, right up, right back down. As soon as we were able to go out and start seeing properties, feeling and touching them again and buying them, that's what happened. Last year was a very difficult year. Months of inventory shot up and then it's coming right back down. Low rates equal low supply. Then rising rates equals increased supply. Every single time. So price indicators, higher the climb, higher the fall. I keep talking about that. That is just a cyclical thing. Remove the ups and downs and the market is close to where it should be compared to the 10, 20, and 30-year averages. So we're at 1,026,000. We got up to just over 1.3. And anyone who bought at that peak, they just have to hang on for another 2 years. That's going to come right back up there. Like the real estate is a long-term game. No one should be losing sleep over this. When I buy a new investment property, a pre-construction condo, I'm looking at it for a 20-year time horizon. I've eliminated all of my risk because it does not matter what happens in the next 3 or 4 years. I know over 20 years, I will average 5 to 8% compounded annual growth. And then once that's levered growth, you're talking every year, 30, 40% growth. You just don't get those returns anywhere else. And you don't get the limited risk in anything else as you do with real estate over the long term. We just saw the biggest correction since 1997 because the market severely overshot in 2021. I mean, look at that correction. That is the biggest correction we have ever seen. You guys want to talk about opportunity? If this is actually the trough, if we're at the bottom, you guys could buy deals right now. I'm already seeing prices go up. My segment, downtown Toronto condos, I wouldn't be surprised if they're up close to 10% since beginning of December. Still incredible opportunities out there. Most of the demand is still waiting on the sidelines. So if you're in the market, don't wait, get ahead of it and let us help you out. 2016, we overshot. 2008, the pullback was smaller because we didn't overshoot much. Examples of 2028, again, it was really quick. We see prices, it was not crazy aggressive sales. So it overshot slightly. Quickly, sales went back up, had consistent sales. And then the higher it goes, the lower it goes. All right, so let's talk about the different unit types, see what's happening in the market. So this is, I'm speaking specifically about resale. The semi-row town market exploded in January. Sales surged 51% year over year, far outpacing the 10% new listing growth. This led to a tight market with 62% sales to new listings ratio and only 1.6 months of inventory. Now that's really interesting. So the townhouse market is hot. There's not a lot of townhouse inventory hitting the market. And the way I look at the way the market works is everyone would own a detached low-rise home with a big backyard and a big pool if they could afford it. The reality is they can't. What's the next best thing? You're looking at townhouses. What happens when you can't afford a townhouse? Then you're looking at the condo market. So pricing and demand is driven by affordability. So I think there are some opportunities. We have a few great townhouse projects we're involved with right now. A few of our investor clients have invested there. Reach out. We can chat with you about those. The detached home market saw significant activity in January. Sales increased 27% year over year, even with a 4% drop in new listings. The tighter market led to a 9% decrease in active listings, leaving only 2.1 months of supply. There just aren't a lot of options to buy low rise in the GTA. So detached homes plus 0.8%, semi-rose plus 0.7%, saw slightly year-over-year price increases, while condos experienced a small decline. However, compared to 2 years ago, condo prices are down less at 8.8%, then detached homes 22.5%, and semi-rose towns at 19%. And that's because Toronto's condo market has been obviously very resilient, but it didn't see the same amount of demand with low interest rates that low-rise saw. People tried to bite off more than they could chew. They went for big houses, the affordability I talked about. And that's really where we saw the market overshoot, and it's pulled back a lot. It's going to go back though. Condo supply increased in January with new listings up 17% and active listings up 25% year over year. However, strong demand, sales up 41%, led to a decrease in inventory to 3.45 months of supply. While still the highest inventory among housing types, this suggests a tightening condo market compared to November 2023. This is important. There is still opportunities for buyers, investors in the condo market. That will not last. I want to add to that about the condo market as well. Q4 2023 saw 11 buildings with 100 plus units take occupancy. To put that, in perspective, this was a record quarter for delivered condos. In perspective, Q4 2022, Toronto only had 2 buildings with 100 plus units take occupancy. So we have a lot of inventory hitting the market that was sold 4, 5, 6 years ago, and that's coming due. Now, the GTA averages roughly 30,000 newly built condos each year. Sometimes they're spread out, and sometimes a lot hit all at once, as is the case in Q3 last year. We need well over 52,000 of the old number before the last 2 years of immigration, and growing new homes in the GTA each year to keep up with the demand. So there is a shortfall of 20,000 homes, which will continue to push rents and prices up further over the long term. What will really be interesting is in the next 18 to 24 months, when analysts expect less than the roughly 30,000 per year average newly built condos to be delivered due to the huge reduction in new home launches and sales over the past 24 months, and much lower applications to build new homes. So not only has our already severely undersupplied market not had aggressive sales, in the past 24 months have had very weak sales and fewer launches, but there's also way less supply in the pipeline. There are fewer applications, permits that are going in to build and to fill this gap. So, when I talk about all of these units hitting, that will eventually dry up in 18, 24 months. And I believe we're going to see double-digit growth in downtown condos by the end of this year. But what's going to happen in the next 5 years is a very positive story for real estate investors. Rents are going down between 6% to 13% drop in rents from December to January. So that's a significant thing. And I've had a few clients reach out to us. I own a property management company. We manage over 200 units, I think over 300 now. And I work with a lot of investors, obviously. So I get a lot of these calls. Now, that was simply because so many units came to market in December of last year. And that really did drive down rents. Now, most of that has been absorbed. I shouldn't say most, a lot of it, maybe most has been absorbed, and we're starting to see rents go back up. We're starting to see multiple offers again on rents. So when you look at the amount of supply that comes in a year, 30,000 condos, spread out over a year, that is always going to be not enough, and that will drive prices up. But if in 1 quarter, 1 month, it all hits, you might be dealing with a little bit too much supply, and that could impact the short-term rent and price value of your investment. Rents are seasonal and are impacted by new supply, and that is why rents are down temporarily. This is nothing new, but the supply always gets rented and prices head back up, and rents are seasonal and are impacted by new supply, and that is why rents are down temporarily. This is nothing new, but the supply always gets rented and prices head back up, and demand is far stronger than supply over the period of a year. So month over month, GTA high rise average price increased slightly from 695 to 702,000 in January. From December to January, GTA low rise average price saw slight decreases from 1.287 in January in December to 1.235 in January. Toronto average price for both high rise and low rise stayed almost the same at 720 in December and 1.385 respectively for low rise. So I've been watching these key indicators for 20 years. I call them the affordability gaps. And these are things that I watch closely. I look at the data every month. A big reason why I started investing heavily in downtown Toronto and then later in Hamilton was because I was looking at these metrics, and it's more of a macro, not a building metric to look at, but kind of a downtown Toronto versus 905 metric and really affordability metric. So what do I mean? So the affordability gap, low rise versus high rise. The average price for a detached home in 416 is currently 1.570 and 709,000 for a condo. That's a difference of 861,000. So I often say this: if everyone could afford a detached home with a big backyard and a pool, they would. But then affordability kicks in and they get pushed to the condo market. And when there's a gap, affordability gap as big as it is currently, that's usually an indication of where low rise prices may go and where high prices may go. And since I've been tracking this, the biggest gap I saw was in January 2017 when it was at 865,000, and by the end of 2017, it was only 717,000. So what happened there was the low rise market actually that year went down 2%. It's up a lot more over a long period of time, but that market, because of a affordability metric like this, I saw the low rise market coming down, and I saw the condo market about to take off, where it saw actually just over 20% growth in condo prices over 2017. This is the affordability gap, where I then look at it and say, okay, but if someone can't actually afford a condo in Toronto, where are they going to go? They're going to go outside of Toronto. They're going to look in the 905. So typically what happens is this kind of goes in and out. But in November of last year, the affordability gap was very narrow between 905 prices and 416 prices. So I told a few clients, I go, watch this. I think that we're going to see, before the optimism came into the market based on this affordability gap, I thought we were going to see condo prices in downtown Toronto start to see appreciation because, a lot of the demand, most people want to live, work, and play in Toronto, but if they can't afford it, they buy a 905. But if the price is similar, they're going to most likely, the masses, buy in Toronto. And we actually did see prices pull back in 905. Excuse me. And then prices are starting to come up in 416. Now, this is a short period of time. So, and sales haven't been, historically all that high. So the data may be off over a 1 month, 2 month data set. But we'll see next month. I think, I've watched this before, and if you have 2 months of this data, I think it's pretty compelling that Toronto condo prices are going to see a lot more interest. Key takeaways. So we're turning a corner. Momentum in the GTA housing market that began in December is expected to continue in 2024. Will we see another spring of 2023? I think we'll see something similar. I don't think it'll be anything close to what we saw in 2023. There was just, I think there's more economic factors and uncertainty. And I think we've been in this stalemate for so long that there's, I think that we need more time for mindset to really shift. But when the supply and demand fundamentals kick in, and we see rates come down, I do think we're going to see a lot of price appreciation, especially in the GTA. Inflation is down and rate cuts are expected to happen sooner rather than later. 5-year bond yield is making its way down, which means fixed rates are going to drop soon. Sales are up, listings are down, causing months of inventory to drop into a seller's market. I didn't mention what a balanced sellers and buyers market is. So months of inventory, anything below 4%, represents a seller's market, meaning you should expect price appreciation. In between 4 and 6% is a balanced market. So prices may come down. They may go up. Probably not going to drop off a cliff. Now, when you get into 6 months of inventory, that's a strong buyer's market, and you typically see a lot of price depreciation, which we haven't even got into a buyer's market, even given the last crazy 3 years. Toronto is a very resilient real estate market, and the supply and demand fundamentals will always drive price at the end of the day. Future supply will come down further and demand increases, causing the perfect storm for real estate investors. I am having a lot of conversations. A lot of people are coming off the sidelines and investing. Typically what we see is we see the resale market start to pick up. The media gets a hold of it. People start coming back into the resale market. That's already happened. And then investors start coming back off the sidelines because prices are going in the right direction. And, there's some incredible opportunities out there right now in the new home resale market. Reach out to my team. We'll share them with you. I don't think I'll be able to say that in 6 to 12 months. There's always good opportunities where we focus on the right projects for investors. And that's why it's important to work with a team that can guide you in the right direction. We won't just sell you anything, but there are more opportunities right now than there have ever been in the 20 years I've been doing this in terms of low deposits, closing costs, discounted prices. It's a really good time if you've been waiting to invest to get into the market. Just to wrap things up, this is the newsletter that you're hopefully reading. This is what we're currently selling. Wave Garden, Punta Cana. I've been investing in Punta Cana. My goal is to have a 5-unit portfolio in Punta Cana within the next 5 years. There is tremendous cash flow. They offer financing to Canadians. I've bought one there already. I will be buying one in Wave Garden once my refinance comes through. Reach out to me or someone on my team. We'd love to share the details with you. Boulevard Q is being built and sold by Mattamy. Mattamy is the leading, arguably the top builder in North America. And they've got an incredible project in Etobicoke. There's a lot of development, a lot of exciting things happening, future growth happening. Turning my lights back on, the motion sensors, it's a growth story. There's a great growth story in Etobicoke. This project is a low deposit. They've discounted prices by 5%. Reach out to us. We'll share the details with you. This is really exciting. Pure 8 is coming to Hamilton's waterfront. This is going to be the first new project to launch on Hamilton's waterfront. Stunning building. The waterfront is being completely revitalized. Those of you who know me and my team know we have been heavily investing in Hamilton the same way I invested in Toronto's condo market 20 years ago. I'm seeing all of the fundamentals in Hamilton. I'm investing there. I will definitely be investing in this project. Free Toronto, stunning project. Stay tuned for this. This is going to be ridiculous in the downtown core next to the financial district. I don't think there is any building that is existing in Toronto like this right now. It's going to be absolutely stunning and high end. For those of you who don't know, we do a tremendous amount of resale. Reach out to me, reach out to my team. We do listings, we help buyers, and we help people with real estate, whether it's investing or resale. I hope you guys stuck around. It was really good to be able to have the opportunity to share this information with you in our February newsletter, and I look forward to bringing you more positive news next month.